and welcome to the India Development Debate. I'm Tamanna Inamdar, and what a show we have lined up for you this evening. No prizes for guessing, but the big story of the day is the monetary policy unveiled today by RBI Governor Shaktikanta Das. So let me quickly tell you what we're going to do on the show today. First up, we're going to talk about the impact, the nuances and the significance of this policy for business, for corporates and for the economy. We have a stellar lineup of guests to talk about that, but we're also going to discuss what this policy means for you, the individual borrower. Should you go ahead and restructure that loan? What if you depend on income from fixed deposits? What options are left for you in a regime where interest rates are nosediving? All of that coming up. We're also going to spend some time focusing on the bizarre rains and the weather patterns we've seen in financial capital Mumbai in the last couple of days, and explore the question whether there's more to it that meets the eye. Is this linked to climate change? And do stay till the end for an interview where I caught up with Gautam Singhania. We were talking about how India can be revived, and he has a lot to say about the IPL not taking place in India but in the UAE. So a lot of stuff lined up for you today. Do stay through, but let's begin with the big story. So in the beginning of the day, at the start of the day, everyone was wondering whether RBI Governor Shaktikanta Das would talk about the moratorium. Would there be an extension? Would there be some hint about an extension or not? Well, it turns out that that point is now moot, because what has been unveiled instead is a comprehensive lifeline for India's businesses, MSMEs and households. Let's begin by getting you the key highlights of what the governor said today.
The disruptions caused by COVID-19 have led to heightened financial stress for borrowers across the board. It has been decided to provide a window to enable lenders to implement a resolution plan in respect of eligible corporate exposures without change in ownership, as well as in respect of personal loans. With a view to mitigating the impact of COVID-19 on households, it has been decided to increase the permissible loan to value, what they call LTV ratio, for such loans to 90%. External demand is expected to remain anemic under the weight of global recession and contraction in global trade. Real GDP growth in the first half of the year is estimated to remain in the contraction zone. For the year 2021 as a whole, real GDP growth is also estimated to be negative. That in an environment of unprecedented stress, supporting recovery of the economy assumes primacy in the conduct of monetary policy. While the space for further monetary policy action is available, it is important to use it judiciously. The pandemic poses a challenge of epic proportions, but our collective efforts, intrepid choices, innovations and true grit will eventually take us to victory. Courage and conviction will conquer COVID-19.
Show this evening is Rajkiran, MD of Union Bank of India. Kaushik Das, Chief Economist of Deutsche Bank, also joins me in conversation, as does Mythili Bhusnurmath, Consulting Editor, ET Now. Welcome to all of you. Mr. Rai, let me begin by, getting your take. Is it fair to say that the moratorium issue that bankers were so worried about for now is not a major concern, because this restructuring window has been opened? So there is now discretion to figure out who really needs help because of COVID-19. What is your take?
Moratorium period is adequate. Now we should come with a restructuring plan. And RBI has come with a very good plan, well thought of the plan. I think we need to take it forward. Actually, the impact of COVID, we have already given 6 months deferment of all kind of installments. I think that is more than adequate. Now we need to look at the cash generating capacity of the units, do a fair assessment and do a restructuring.
Okay. Tell me, Mr. Rai, how would this work? Now, this, of course, would be at the discretion of the banks, whether it's for corporates, MSMEs, or individual borrowers. How will banks ensure that the right and deserving candidates undertake restructuring? How will you parse through all the information to know whether this is a COVID hit or not, and whether this is deserving? Of course, the RBI has laid down parameters like the account has to be standard as of March 1st, etc. But even so, do you see any challenges in figuring out who the key and right candidates are?
Actually, we are working on all these accounts which are stressed for the last few months. Because after the moratorium was given, we are studying all these accounts. We have a fair idea about all these accounts which may deserve this kind of restructuring. So this should not be a big issue in identification of accounts. But the personal loans and MSME loans which are small, it is much easier to handle. Larger accounts, actually, we need to go deep and look at the cash generating capacity of these units. See, there are certain outer boundaries put here. If elongation of repayment is beyond 2 years, then this restructuring will not work. We need to go back to the original circular of 7th June 2019 and accordingly do the restructuring. So this may not fit under this scheme. So like that, some boundaries are given. These are specifically for those accounts which are impacted only by COVID, which are otherwise good. The first filter itself is put at 30 days DPD as of 1st March. That means people who have missed only February installments are eligible under this scheme. So the accounts which are otherwise standard. So I think this filter is good enough, and then elongating beyond 2 years is also not permitted. And some more financial covenants are likely to come through the Kamath committee recommendations. So I think it will be highly restrictive to accounts which are affected by COVID-19 only.
Mr. Rai, what is the extent of requirement for this kind of aid in your view? I mean, if we have one parameter and not a complete one, is the number of people or number of companies that have gone in for moratorium, and that figure has been dropping for most banks between the first stage of moratorium and the extension. But how big will be the demand for restructuring facilities?
It's very difficult to assess. I don't want to put a number into it, and don't link directly the number of accounts under moratorium to the companies which need restructuring. Companies, to conserve cash, they have taken moratorium. It doesn't mean that they need a restructuring. And in a company's history, restructuring is always a black spot. So many of the companies which can sustain will not prefer to go for restructuring. So I think the number will be much less than what is under moratorium. But then I think at this point of time, it will be difficult to put a number there. But on the large exposure side, we may not see many accounts coming into it. We have done a study of that. It will be more on the medium sector and MSME sector, which may need more of this relief.
Okay. Kaushik Das, I just want to get your view on the extent that this restructuring window and facility will be utilized, and what we can glean on the need of it. I mean, there are always varied interpretations of what's happening with the economy. Sometimes there's talk about a rural recovery, bright spots, etc. But the RBI is pretty clear and quite grim in its outlook for where the economy is going. And the fact that this kind of a restructuring window is required at this point, including for personal loans, etc., does it also tell us how severe the situation is of economic stress?
Tamanna, thanks for having me on your show. A couple of points I want to make. This is the kind of crisis that we are seeing in our lifetime. We have never seen this kind of crisis. So, you can't compare this crisis with the kind of crisis that we have seen in the past. And remember that India got into this COVID crisis in a situation where growth was already slowing down quite significantly after the IL&FS default in August 2018. So it's not like India's economic health was pretty good before the COVID-19 crisis. So you entered the crisis already weak. And then from March till April, May, June, we have seen this lockdown, which has caused second significant shock to the economy. So we know that the estimates for April-June GDP growth is somewhere between -16 to -20%, or it can be even more. Then you have this issue about the thing is that we have a limited fiscal space to support growth. So how do you support the economy? So RBI has been doing all it can till now, and our expectation was that RBI would be more forward-looking while delivering the rate cuts or any kind of easing. So we were expecting some bit of easing today, if not directly, but indirectly in terms of different ways that RBI could have done, maybe just cut the reverse repo rate or increase the HTM limit of bonds. But at this point of time, RBI has chosen not to use its firepower and keep it for a later period of time, possibly in October or December. The bottom line is we are looking at growth falling by 6% or so in this financial year, and possibly even more to 8% or 9% if this localized lockdowns that we have seen keeps on getting more broad-based. So that's a concern on growth. And next year also we will see some recovery, obviously, because of the base effect. But if you consider the GDP levels that we are in at the end of December 2019, before the COVID-19 crisis hit us properly from February, March, we are going to take a long time to go back to those levels, and it might take 1.5 years or 2 years to go back to the same GDP levels. So I think we need a lot of policy support, and it was almost evident that one-time restructuring of loans was needed for the economy. Now, as your previous speaker mentioned, unless the moratorium period gets over, it will be difficult to kind of put a number as to how much this restructuring requirement would be, and or to what extent or for how long we need to go through this process of helping the economy. So we'll get to know that after 31st August once the moratorium comes to an end. And what we need also, I think, is that the banks need to get recapitalized urgently, so that they can manage the problem that will come up in the next 9 months.
I want to talk about that problem that will come up in the next 9 months, and I'm going to go across to Mythili for it. So this, lot of restructuring has come with a lot of riders. A lot of entry barriers, a lot of conditionality. But Mythili, do you think it's enough to ensure that we're not heading into a situation where we have another big fat NPA problem facing us 9 months or a year down the line?
Well, I think NPAs are inevitable in a pandemic like this. So I think that is something that we must recognize. There's no getting away from it. And though it is good that the RBI has recognized the need for restructuring, the kind of strictures, the kind of riders that they have put in, I think it really is perhaps going to do more, harm than good for the entire purpose of reviving the economy. Simply because the first and most important requirement of any restructuring program actually is both speed and agility. And the kind of riders that the RBI has put, take for instance the fact that you need to have an expert committee under Mr. K.V. Kamath going into the parameters for each and every sector. They will submit their recommendations. RBI will take a view on their recommendations. All this is going to take time. Added to that, then the committee will go into the specifics, the process of each and every resolution program. And then it has also to be vetted by a rating agency. So there's so many strictures, so many riders. RBI is understandably worried that we don't have a repeat of the 2008 crisis, when agreed banks went a little overboard and credit expanded so hugely that we had the problem of NPAs that we're sitting with right now. But banks have learned their lesson. Now today, if you don't give them the flexibility, the elbow room that they need, then in the whole process, you're going to lose both the speed as well as the agility, which is so important for banks. Let us remember that whether to restructure or not is a commercial decision. It is not a decision that a regulator or supervisor should take and ought to take. So I fear that the RBI, in its desire, understandable desire, not to repeat what happened in 2008, has gone now to the other extreme and put so many riders as to take away from the very benefit of extending a facility like restructuring, which is absolutely essential at this juncture.
Very interesting point there. Mr. Rai, I'd love to hear your view on this. Has the RBI played it too safe? Too many hurdles to cross? And add to this the fact that banks have also been very, very cautious. Even though the RBI has been nudging them to give out loans, banks themselves have been putting in their own filter of caution. So on top of this, do you see that coming in as some sort of a hurdle to actually go out and extend this restructuring facility?
See, we need to understand RBI has put a very detailed guideline on restructuring on 7th June 2019 circular. So this circular is still applicable for all the accounts. So what we wanted is a modification in this circular so that we can do the restructuring with the existing promoter, because that circular lays emphasis that if you have to retain the standard status, there should be a change of promoter. Whereas now actually our demand was, because these are very good accounts which are stressed only because of the COVID impact, you should permit us to do the restructuring with the existing promoter and retain the standard status. So I think this is what RBI has given. So the restrictions are put on for only this kind of restructuring which can happen with the existing promoters. So the earlier guidelines are still valid. So if somebody is not fitting into these norms or they are not able to play within these rules, then you have to go back to your 7th June circular of 2019 and accordingly do the restructuring. So that window is already available to us.
All right. So, that's an interesting point. Mr. Rai doesn't see it as, such a big sort of hurdle to be jumped. While I have you, Mr. Rai, I do want to get your view on the gold loan and the value that you can take a loan being increased to 90% from 75%. A lot of views out there today saying, does it really make sense? Especially now when gold prices are just skyrocketing. They're above 53,000. Someone takes a loan today at 90% and then, vaccine comes around and the levels plunge. What are the kind of challenges do you see here? Does the whole gold loan perspective make you a little uncomfortable?
Actually, no company is going to jump and give 90% of the value in the present prices. They will be very prudent in giving these loans. So, but what RBI has done is relax that norms, because at this point of time, what we observe, most of these self-employed category entrepreneurs, they are likely to borrow through gold loans to invest back in their companies. So this relief might have come in that context, so that they can raise more loans. So, but then companies will be very prudent in providing these 90% at the present prices.
Okay, Mythili wants to come in. Yes, Mythili.
Tamanna, I had a rejoinder to what Mr. Rai's contention about the June circular. The June circular was far too rigid. It gave absolutely no flexibility to banks. Yeah. Today, what the governor has announced and the circular that has been released today is better, but it doesn't go as far enough as it should. As I said, banks are in the business of taking risks. Their only job is to manage risks. So they need to be given the flexibility, they need to be given the elbow room and not have somebody else breathing down their neck, second guessing on their behalf. What is important to realize is that when you take a decision, it could be right, it could be wrong. And as long as the decision has been taken after due diligence and in good faith, they should not be penalized unless there is proven malified intent. Today, the problem is that every loan that is that goes bad, it is presumed that there is malified intent, and bankers are hounded by all the investigating agencies. In such a scenario, no banker is going to kind of take the risk and do his business, which is the business of taking risks. So I think the fundamental point that you need to give to bankers is that you are free to take your decisions as long as it is based on proper due diligence in good faith and bona fide. As long as it is bona fide, if the decision goes awry and the account becomes NPA, you will not be penalized. RBI has, even last time when it issued the circular, it said that the RBI retains a right to decide whether on the justifiability of the loan that is given, is it because of COVID, is it not because of COVID? Now these are things that are very difficult, they're not laid down in stone. So some element of judgment is always there. So it's like a parent who allows a teenager to go out. First time he goes out, gets drunk and comes back. Second time, you don't allow him to go out, or you impose so many conditions on him that it virtually takes away his entire freedom. So I think it's important that RBI lets banks grow up, treats banks as adults, And as yes, it doesn't want a repeat of 2008.
Yes.
So it does need to have some caveats, but not go overboard like I think it has.
I have to. I'm sorry that was such an interesting parallel that you drew. That was such an interesting parallel that you drew that I have to get Mr. Rajkiran Rai's rejoinder. Yes, Mr. Rai, do you think it's time that banks are allowed to grow up, as Mythili puts it?
I fully agree with ma'am. Actually, her views are right. But then, see, RBI is concerned with the financial sector stability. So we need to give that weightage to RBI because always they are working on that. So financial sector stability is which is foremost in their mind. Now, at the same time, like this can be argued endlessly that what is right, what is wrong, and all that. But then the experience of a regulator in the previous time when they provided the restructuring, everybody misused it. Maybe banks also played along, the borrowers misused. So ultimately we have to do a AQR. So that kind of things are there in the weighing in the mind of the regulator. So that's why they are more prudent in giving these relaxations. But we need to prove. What I feel is as bankers, at least this time around, we need to prove our capability in handling these issues so that the regulator gets more confident about the banks and they give us a free hand. So ideally what Mythili madam says is right. Actually bankers' commercial decisions have to be respected. They need to be given that elbow room to work. But then regulator may not be comfortable at this point of time. Maybe this time we will prove them that like we can be very prudent in this. So next time around I think we get more elbow room.
So the question is, yes.
Yes.
Yes, a free pass on the weekend to go out, as Mythili makes that example. Kaushik Das, I want to get your view on this. The free hand is not there because of a poor track record. How can we ensure that those mistakes are not repeated? Mythili thinks that the conditions are too stringent for allowing this one-time restructuring. Do you think that they're too stringent, or do you think that there is still a very palpable and real concern that we're going to be sitting with a whole bucket of NPAs, more even so, a year down the line?
I agree more with Mythili, and I think the most important point that she made is that every minute that we are discussing all this, we are losing time. And today, time is of essence. So, we've seen this crisis starting from March, and even before that, for the last 2 years, it's not like the Indian economy was doing great. So growth was slowing down even till October, December of last year. So now you are in this crisis. We have got a lot of policy response from the government side, but not to the extent that would have, helped in kind of supporting domestic demand. That's because the fiscal side is also stretched, and you are expecting any kind of fiscal support, incremental support, to only come in the second half of the fiscal year. Now, RBI is also delaying the rate cut. So, for example, RBI did not do anything today, and possibly they will take October or December to do another rate cut. Now, I can understand, okay, 125 basis points rate cut here and there will not make a difference. But we should remember that, today when you consider rates to be low, you should also consider that growth is going to be low in probably the last 50 years or 100 years that we have seen. You cannot compare today's interest rates being low with the last 10 years low and say that we have reached the bottom. So the point is that RBI is delaying because of concerns on inflation, which in my view, RBI should be more forward-looking, and inflation is expected to come down. So they should have reacted now, because anyway, monetary transmission works with a lag. And the second thing is fiscal, support is going to get delayed. So if monetary support is delayed, fiscal support is delayed, if all these regulatory announcements that have been made will take time, the committee will, kind of judge, and maybe they'll take time to give recommendation to RBI. RBI will then look through those recommendations. So it will take quite a bit of time, within which every day, every week, every month, the situation in the real economy could be actually kind of becoming worse and worse. So probably you're going to see the recovery taking place over a longer period of time, and that is something which India will have to deal with.
Okay, that's a very interesting, point you've brought to the table, Mr. Kaushik Das. It's like if a man is drowning, he needs the lifeline now. Instead of a very detailed deliberation over how it should be thrown to him. We'll leave it at that, but I want to thank all of you for joining us on the first big discussion this evening. There's a lot more coming up.